We are coming back with another discussion. This is LKAS 10, events after the reporting period. Come on. It looks like a very simple standard to understand, to comprehend. It is a very lighter standard, not so heavy, the contents are not so heavy. But still I have seen among so many students there are a lot of misunderstanding and misconceptions and myths. Because we have been doing it over the period, starting from right from A level right up to the corporate level sometimes. At many times we have done it many more times, but still there are certain areas to be further clarified. Events after the reporting period. Let me explain why this can be important in financial reporting, also how it can be important for you all at the exam. Now, in preparing financial statements, you need to set your reporting period. Basically, it has to be a complete year financial reporting period should be a complete year. So, some people conveniently set their financial period which is consistent to the tax period, so that ends on 31st March, that is all right. And some people for certain reasons will set the financial period, financial year which is consistent with the calendar year starting from 1st January and ends on 31st December. So, there is no hard and fast rule, that depends on your requirement. Either you can have it on 30th September, no problem. You can have it on 30th June, no problem. But it has to be a complete 1 year, right. Now, let me take the financial year starting from 1st January. So, let me take a year 2020 for my convenience, and the financial year ends on 31st December 2020. 31st December 2020. So, you need to prepare the set of financial statements, including the profit and loss, including the statement of financial positions, including the statement of cash flows, including the notes, and so on and so forth. Whatever that has to be included should be prepared in preparing the complete set of financial information. Now, if you think of a small balance sheet starting right from the land and buildings right up to cash and bank balance, more than 95% of the items we show in the balance sheets are estimate based. Now, if you think of property, plant and equipment by and large, no matter what is included right within, most of the items of property, plant and equipment are estimate based. If you think of cost model, cost minus cumulative depreciations, in calculating cumulative depreciations you need to estimate their useful lifetime, you need to estimate their scrap value, and based on that only you will estimate the depreciation figure. And even if you apply the revaluation model, once again you need to make couple of estimates, even including the revaluations, the fair values, and then the lifetime. Once again they are estimate based. And if you decide to show investment properties at fair value model, fair value is an estimate. And even if you decide to show investment properties at cost model, once again cost minus cumulative depreciation, to decide depreciation figure you need to estimate the lifetime, and so on and so forth. So, each and every, more than 95% of the items you show in the balance sheet are estimate based. Now, how can you do estimates? To make estimates, you need figures, you need facts, you need informations, and you make those estimates based on the prevailing conditions, prevailing circumstances. Now, say we will assume that suppose you were in a physical class, I have the independence and the freedom just to throw a couple of questions to audience, just to assess their level right before the exam, well in advance I can make some assessments. Just imagine we having 100 students in the audience. I will start throwing some questions to each and every single students in the audience and nobody answered me right. Then what is my assessment? My assessment is passing rate this time will be 0. So, how did I make that assessment? I made that assessment based on the facts, based on the informations collected on the prevailing circumstances. Now, we just started our classes, the exam will be in 6 months ahead. So, the people have time to get ready for the exam and they have not even thought of, far from studying, so even they have not still thought of studying. So, it is very unlikely of someone answering my questions, why they are not still prepared. But just say 1 month ahead of the exam, I will throw the same question to the same audience and everyone whom I raised the question from answered my questions. I am well satisfied because answering is 100%. Now, my estimate will be different from, it is from being 0% passing rate to 100% passing rate. So, how did I change my estimate? Because I am getting some new informations, new facts based on the prevailing circumstances. My percentage, my assessment of the percentage now will be changed from 0% to 100%. How did I do my change of the estimate? Because I am receiving new facts and new informations now. Now, what I am saying is, since most of the figures in the profit and loss and in the balance sheet statement of financial position are estimates, they are estimates based. For you to do estimates, you need to have right figures, accurate information based on the prevailing circumstances. Now, are we getting the right and the correct information right on the reporting date or well before the reporting date to make all these figures accurate, to make all these estimates to present them in the balance sheet? We are not getting all of that information right on the reporting date or well before the reporting date. Some of them will be received later. And that is where the problem is, and that is what we are going to discuss today in this video. How we do or how we react for the important information that we receive subsequently in a way that the informations we receive subsequently can be made use of to do accurate estimates of the items in the financial statements on the reporting date. Now, before that, you need to identify the reporting date. In my illustration, the reporting date is 31st December 2020. And also you need to identify the subsequent reporting period. What do you mean by the period which is subsequent to the reporting period? That is the period commencing from the reporting date to the date on which the financial statements are authorized by the directors for publication purpose. Now, this is the date. So, let me take a date randomly, hypothetical date. So, this is 30th April 2020. In between, you need to do a lot of things. You need to invite auditors and they will come and stay over a couple of months. And they will do the audit, and then only we will prepare the annual report, and the financial statements need to be authorized by the directors for publication purpose. Now, do not get confused. Sometimes there are instances where sometimes certain shareholders also need to authenticate or to approve the financial statements for publication purpose. But that is not what is required by LKAS 10. What is required by LKAS 10 is the authorization by the directors for publication purpose. Now, the examiner himself can complicate the questions at the exam by loading some unnecessary information. The examiner might say the directors have approved financial statements on 30th April for publication purposes, and as required by the articles of the company, two shareholders also approved the financial statements for publication purpose on 5th May 2020. So, how will you decide the period which is subsequent to the reporting period? It has to be the period commencing from the reporting date and ending on the date on which the financial statements were authorized by the directors, not by the shareholders, directors for publication purpose. So, that period should not end on 5th of May, it has to end on 30th April as per the requirement of LKAS 10. And this is the period which deserves your prompt attentions. This is what is required is not the attention for the reporting period. What is required is to pay attention to the subsequent period to the reporting period. This is the period which requires your attention. Why? Sometimes during this period which is subsequent to the reporting period, you will get multiple number of informations that would have been of an immense use on the reporting date to make assessments of the values of assets, liabilities, equity to be presented on the reporting date in the financial statements. Now, what happens here is, during the subsequent period, so many events occur, so many events take place, providing you informations, facts and evidences in a way that you can make the assessments of the values of assets and liabilities, equity, income, expenses on the reporting date. And as a result, LKAS 10, what they do is, the events that occur during the subsequent period to the reporting period are taken into two categories. I hope you got my point. Why are we talking so much about this subsequent period? But that is the period during which some important and significant events take place and occur, which are of an immense use to estimate, to assess the values of the assets and liabilities, equity to be presented on the reporting date balance sheet. And without those events, without the information provided from those events, we would not be able to make the correct and accurate, right assessments of assets, liabilities, equity to be presented in the financial statements on the reporting date. Now, LKAS 10 divides those events into two. In short, for our convenience, we have given them two names. Some events are called adjusting events. Some events are called adjusting events and the other events are called non-adjusting events. Non-adjusting events, right. But that is not the terms to which you need to get accustomed to. You need to remember the proper definitions and interpretations of those two events as prescribed by LKAS 10 standard. What are adjusting events? These are the events that provide information and evidences to the conditions that existed on the reporting date. And this is where most of us get stuck without being able to realize what conditions that existed on the reporting date were. We get stuck here. So, this is the correct way of defining and interpreting adjusting events as per LKAS 10. Adjusting events are the events that provide informations and evidences to the conditions that existed on the reporting date. Non-adjusting events are the events that are indicative of conditions that arose after the reporting period. Non-adjusting events are the events that are indicative of conditions that arose after the reporting period. Now, no matter how much you try to memorize and by heart it, you need to get down into the detailed explanation. You need to get down to the really, you need to get down to the real depth of the meaning of it and to see what it is. And I need to give as many examples as you need is important to identify, to understand the two concepts, adjusting events and non-adjusting events. Now, let me give you a couple of examples. Through the examples only, I can convince these concepts and not by explaining these two events of adjusting and non-adjusting. And I must explain this part first, conditions that existed on the reporting date, and that is what is important here. If you fail to understand that part, going forward will be too hard. Let me first take adjusting events Those are the events that provide information and evidences to the conditions that existed on the reporting date. I know many of you all back in your school days would have had the practice of by hearting some examples for the first one, adjusting events. But that is not how we should do it, and you need to understand the concepts really, and you need to see what and what can be adjusting events and what cannot be. Let us look at it. Now, most of the financial reporting standards prescribe how the assets liabilities should be measured and valued on the reporting date. If you think of LKAS 2, inventories, LKAS 2 prescribes how inventory should be valued on the reporting date, and you can remember it is the lower of cost and NRV. LKAS 16 prescribes how property, plant and equipment should be measured on the reporting date. It has to be either cost model or the revaluation model. LKAS 40 prescribes how investment property should be measured on the reporting date. It has to be either the cost model or the fair value model. SLFRS 9 prescribes how the subsequent measurement of financial instruments should be. It has to be either fair value or the amortized cost. And there can be so many other examples, and I can't stop giving you the examples just in an hour or maybe in 2 hours time. It can be a multiple number of examples. Now, say for you to value the inventories at the lower of cost and NRV as required by LKAS 2, again you need to have right information and right evidences, without, in the absence of which the inventory value that you show in the profit in the balance sheet statement of financial positions is not the correct and the true value of inventories, and so should be property, plant and equipment, so should be investment properties. Very simple example. On the reporting date, which is 31st December 2020, we had 5 million worth of debtors. And in numbers, we had say 60 customers with us, and these customers have been with us right from the time of immemorial. Ever since we started our business, those customers were with us, and those customers are so creditworthy that we are 100% sure that they will never default us. And if you take the past records of all the customers, they have done the settlements exactly on time or well before the due date. So, we have no problem, no fear. The value of the debtors outstanding balance is 5 million rupees, and we went back to past records as far back as possible and checked and verified their settlements. All the settlements were prompt. So, there was no need to make a provision for impairment or provision for bad debts. 5 million is the gross amount of debtors on the reporting date. The provision for doubtful debts or the provision for impairment was 0, because we tried as much as we could to collect information and evidence to see how unlikely some of these customers settling us in the future, but there was no clue, there was no tip, and there was no evidence that any of the customers, none of the customers will default. So, we never provided for impairment, or we never provided for doubtful debts on the reporting date. So, we showed debtors at which value 5 million rupees. But if you go to SLFRS 9, debtors or the trade receivables fall under which category of financial assets measured at amortized cost? So, how does SLFRS 9 prescribe what is the accounting recommendations for debtors? You need to show them at amortized cost minus impairment of debt or impairment provisions. So, this impairment provision cannot be created because we do not have enough information, or we do not have right information to make the judgment as to how unlikely those customers settling us, or how likely these customers defaulting us. Now, well before the date on which the financial statements were authorized by the directors, one particular customer who owes us 1 million rupees met with a severe accident, and he closed his eyes never to open again, and he did not have any relatives, he did not have a wife, he did not have kids and children, and there was no way for us to collect this 1 million rupees. Now, see, in the absence of proper and right information on the reporting date to assess as to how unlikely we are receiving or how likely the customers defaulting our payable balances, we could not create a provision for impairment on the reporting. That was not because of anything else, because we did not have any clue, did not have any information on the reporting date. And that fact of information or evidences which we did not have on the reporting date becomes available during the subsequent period with this ill-fated accident of our customer, and that particular event provides us information, gives us evidences enough that the entity will not be able to collect this 1 million rupees from this customer. So, as a result, the provision which we would have made on the reporting date can be created now, better late than never. We could not create that provision for bad debts on the reporting date, or we did not create that bad debts write-off, did not create that provision for bad debts because we did not have that information on the reporting date. Now only we are receiving that information. So, we will make use of that information's evidences from that ill-fated event during the subsequent period to assess our provision for bad debts on the reporting date. So, we will get back to the reporting date and do some changes. We will bring down our receivable balance from 5 million rupees to 4 million rupees. Now, without you applying the standard, I want you to realize how important the informations, the piece of information we got during the subsequent period in assessing the correct and exact receivable balance of debtors on the reporting date. So, the information that we would have received on the reporting date was never received on the reporting date, and that was received during the subsequent period, but that is of an immense use to assess our debtor balance on the reporting date. But does it say that all the events that occur during the subsequent period need to be made use to adjust it on the reporting date and to redecide our assets, liabilities, equity balances on the reporting date? No. Some informations will be used to reassess and some informations will not be. That is why we have taken them into two categories as adjusting and non-adjusting events, and this particular event became an adjusting event, and let us see how it was decided to be of adjusting event category, and let me take some more supporting examples. Reporting date 31st December 2020. And just few months ahead of the reporting date, one of our customer took legal actions against our company for providing defective goods to the customers, and the customers are now claiming 100 million compensations for the losses they have occurred for providing defective goods to our customers. Now, the case was taken for hearing in the courts, and the lawyers who appear in our favor and the lawyers who appear in favor of the other party, I mean in favor of our customers, have concluded that we will lose our case, we will lose the case and we will become liable to pay compensations. But how much of compensations need to be paid is still questionable, and those guys are asking 100 million, but the amount of compensations to be paid cannot be decided by whatever the techniques you use. You have traced back to the similar cases previously, still the amount of possible compensation payment cannot be figured out. And you tried to figure out possible compensations by receiving some opinion from the experts. Even the experts have not been able to give the correct opinion. And you have tried all the possible methods to figure out the possible compensation payments to the affected parties, but none of the methods we resorted worked really to give us the figure. So, then the entity decided to disclose this as a contingent liability. Contingent liability, why did it become a contingent liability? We know it is as clear as crystal, we becoming liable to pay the compensation, but it is just that we cannot figure it out until the judgment will be delivered in the future. We do not know how much compensations will become payable. Then, without you recognizing the liability and without you recognizing the related expenditure, we proceeded to prepare the financial statements which do not show the possible compensation payables as a liability and as an expenditure in the financial statements. Now, the financial statements were authorized by directors on 30th April 2020 for publication purposes. They were authorized for publication purposes on this date. So, the period commencing on 31st December and ending on 30th April should be the subsequent period. So, during the subsequent period, the case was taken once again for hearing and the judgment was delivered against us, and the magistrate has ordered us to pay 80 million rupees as compensation. Now, what if the judgment had been delivered right before the balance sheet date without it being disclosed as a contingent? You would have been able to recognize 80 million rupees as a payable and as an expenditure. So, we could not do it because we did not get the judgment right before the reporting date. Now, this is what you need to convince yourself. A liability is truly existing on the reporting date or is not truly existing. A liability is truly existing on the reporting date. But it is only just that you can't measure it, the value of the liability in terms of rupees and cents. We tried with all the possible methods and approach to figure it out, but nothing worked really out. If for some reason you got the judgment right before the reporting date, you would have included 80 million rupees into liabilities and into expenditure. Now, the event of the judgment being delivered during the subsequent period is not just another event, it is an event of providing you the required evidences and information in a way that you can assess the true value of the existing liabilities on the reporting date. It is not just an event to be ignored. The event of the judgment being delivered has been an event with an utmost use to the entity, because that is an event that provides evidences and information in a way that you can judge and estimate the value of the existing liabilities on the reporting date. So, then irrespective of the fact that this event that provides us the figure of the existing liability took place subsequent to the reporting date should be used to assess your liabilities on the reporting date, and you need to adjust your financial statements by debiting expenditure by 80 million rupees and crediting liabilities by 80 million rupees. So, the contingent liability that was simply disclosed on the reporting date has to become a liability on the reporting date. Why? That event of the judgment being delivered does become an adjusting event. Why? It provides evidences and informations to the condition existing on the reporting. What is the condition that existed on the reporting date? The condition was the existing contingent liability. Why did it become a contingent liability? That was the very inability to figure it out as to how much the possible compensation liabilities can be, and that existing condition received exact information subsequent to the reporting period, and that information, so that event has been made use to figure out the exact amount of liabilities on the reporting. I hope you got the point, and let me give you some more important examples of events that can be considered to be adjusting events. Once again, so let me take the reporting date as 31st December 2020. And the financial statements were authorized by the directors on 30th April 2020 for publication purposes. So, this is the reporting date. And this is the subsequent period. We have inventories on the reporting date. Inventories are 100 million rupees. This is the cost. And in valuing inventories on the reporting date, you need to make use of LKAS 2. What does LKAS 2 say? Inventories are measured on the reporting date at the lower of cost and NRV. NRV was a question. It was questionable on the reporting date. And sometimes to decide NRV, you can't get required right information right on the reporting date. So then, irrespective of the requirement of LKAS 2 to measure them at the lower of cost and NRV, we decided to continue to show inventories on the reporting date at the cost of 100 million rupees, and that is not the recommended practice of LKAS 2. Disregarding that, in spite of the requirement of LKAS 2, we continued to show them at cost of 100 million rupees. And during the subsequent period, the inventories, just in 2 weeks time from the reporting date, the inventories were sold at 80 million rupees. 80 million rupees. So, that particular event that occurred during the subsequent period of inventories being sold at 80 million rupees gives us right information and right evidences that the NRV, estimated selling prices of the existing inventories, are way more lower than the cost of inventories on the reporting date. So, that event of inventories being sold at 80 million rupees provides us evidences and informations that the inventories need to be written down from cost 100 million rupees to 8 million rupees. So, what was the condition that existed on the reporting date? Truly, the selling price or the realizable value of inventories on the reporting date has been much more lower than the cost, but we could not figure it out because we did not have right evidences and information. And this event of inventories being sold at 80 million is the event that gives us that hidden information in a way that the value of inventories can be accurately measured and can be written down from 100 million to 80 million. So, irrespective of the fact that event took place during the subsequent period, what we can do is we will get back to the reporting date once again and write it down from 100 million to 80 million. Inventories will be restated at this lower value of 80 million and 20 million will be deducted against the profit of 2020. So, see how important this standard is, and lot of people have lot of misunderstanding. Some people have a practice of by hearting some example. For the God's sake, please do not do it. Why? Your paper CL2 cannot be answered by using some set of pre-prepared examples by hearted. So, you need to understand the concepts, and that is what is needed to get through CL2 paper. Let me take some examples. Now, say this is a company where there were shareholders. So, there were 4 shareholders altogether, and they had a profit sharing agreement. Profit sharing agreement. They have set their agendas. Among the provisions and clauses in this agreement was there a provision on how to share the profits of a particular year. And the financial year just ended, and they prepared financial statements, a draft financial statements which had a profit of 10 million rupees. Your actual profit cannot be the profit shown in draft financial statements. Your actual profit, eventual profit should be the profits in audited financial statements. And you know, you all are matured enough to understand that concept. You cannot complete the annual audit of a particular year right within that year, because you need to first complete your draft financial statements and you need to send it to the auditors and you need to get the audit done thereafter. That will, the audit has to be completed obviously in the following year. So, then the financial statements were audited accounts were done, prepared, and in the audited financial statements, the actual profit figure was 8 million. Now, practically, never can you share the profit of a particular year right within that year. Practically, you need to share the profit of a particular in the immediate following year. So, then the profit they shared has to be 8 million according to how they agreed in their agreement, and this event of the profit being shared, this event of the actual profit been reported and the profit been shared should be an adjusting event or non-adjusting event as per case 10. Now, there has to be a condition to which the events that occur in the subsequent period need to provide evidences and information. So, what is the condition which is existing on the reporting date? The very condition that is existing on the reporting date is the profit that has to be shared. So, what is the profit to be shared? It is not 10 million profit that is to be shared. What is the profit to be shared? It is 8 million, and this 8 million became apparent not on the reporting date but during the subsequent period. So, as a result, the event of the financial statements being audited and the event of actual profit being reported provides evidences to the condition. What is the condition? The requirement of the profit being shared was the existing conditions on the reporting date, and that is the condition to which this particular event is providing evidences and information. So coming back, I mean, you need to get back to the reporting date and you need to share the profits on the reporting. What profit to be shared on the report? It is not the 10 million profit which has to be shared, it is the 8 million profit which has to be shared, and you need to show the profit sharing and distributions on the reporting date. Why? This is an adjusting event. What do you mean by an adjusting event? That is an event that provides evidences and conditions, evidences and information. So, the conditions existed on the reporting date. Now, let me take another example of two contrasting events. We have inventories 100 million, this is the cost, and we have property, plant and equipment 200 million. We carry them at the cost model. Cost model should be cost minus cumulative depreciation. Cost is original cost incurred in purchasing something. Now, during the subsequent period, there was a massive destruction of some of the assets as a result of a fire, and everyone was on leave, and there was a sparking of fire, and that developed into a flaring fire just in few hours time, and 80% of the inventories were damaged, and this fire started spreading almost everywhere to all nooks and corners of the company. Even the property, plant and equipment were damaged. Now, the realizable value of inventories became just 20 million after the fire. Realizable value of property, plant and equipment became just 50 million rupees after the fire, and this took place during the New Year seasons, like say 14th of April, and the financial statements were authorized for publication purposes on 30th April. And can both of these events be adjusting, or what and what can be adjusting, what and what cannot be adjusting? So, let me explain. So, there is a condition existing on the reporting date for inventories. What is the condition? Inventories are required to be recorded at the lower of cost and NRV. The destruction of inventories caused by fire will result in the realizable value of inventories being lower than the cost. So, as a result, this difference of 80 million should be written down from cost to NRV on the reporting date. Now, is there a requirement of property, plant and equipment being written down from cost to NRV? Is it required by LKAS 16? It is not. So, if you strictly follow LKAS 16, LKAS 16 does not require the property, plant and equipment items to be written down from cost to NRV. So, there is no condition existing on the reporting date for inventories. Then we will look at LKAS 36. What is LKAS 36? Impairment. Does LKAS 36 require you to recognize impairment on the reporting date? This is not an asset that requires annual impairment review. So, the impairment loss of property, plant and equipment need not to be recognized on the reporting date. Impairment loss need to be recognized on the date on which this event has occurred. So, for property, plant and equipment, a condition of the value being written down from cost to realizable value does not exist. So, you need not to adjust it on the reporting date for property, plant and equipment, and you need to write down the property, plant and equipment impairment loss has to be recognized by writing down property, plant and equipment from whatever the value to whatever the value only on the date on which the fire occurred, but not on the reporting date. And we have lot more examples, and let us see some more interesting examples for adjusting and non-adjusting event. Now, in my presentation, I have given you couple of examples for adjusting events, and let me go through one by one. It is not just going through, I will explain one by one, and some of the examples I have already explained, and let me explain the others which I have not still explained. First one says the sale of inventory after the reporting date. This gives evidence about the net realizable value of inventory at the reporting. I explained that part, I hope that was clear. So, we will move on to the second one. The bankruptcy of a customer after the reporting date. This confirms that the allowance is required against the receivable balance at the reporting date. Even that was explained in my example. So, we can move on to the next one. Third, the discovery of fraud or errors. This shows that the financial statements are incorrect. Reporting year period starts on 1st January 2020 and it ends on 31st December 2020. This is the reporting period. And the financial statements were authorized for issue on 30th April 2020. Now, during the course of the audit, it does not happen in auditing, but we will assume that it is the auditors who discovered that. It happens rarely, once in a blue moon. During the process of auditing, their sampling was so powerful and that was decided in a way that even the frauds by collusions can be detected. And the auditors had the capability and the competency to detect some of the frauds that have been occurring over the periods, years and years, and nobody has ever been able to detect it, but this time the auditors could detect it, a massive fraud. Say for an example, they are manufacturing vegetable oils, and the vegetable oils are stored in a massive tank and that is standing on a concrete pillar. This is about say 100 meters, the pillar itself is 100 meters and this is about another 200 meters top high, right. Now, this is where the vegetable oils are stored, and there are 3 tanks of the same size, same nature, right. Now, for the stock verifications, the auditors are invited, auditors have to be present. The auditors will never climb up to verify the oil level. What happens is, one guy, a representative from the company, the client, will climb up the ladder and will go climb up to the top of the tank, and they will put a stick into this, and then they say, oh, this is the measurement, this is filled to the brim. So, this is say 100,000 liters, the auditors have taken that down. They were seated here on the ground, and some guy has climbed up to the top, and he is the man, he is the one who put the stick into the tank and measured the level of oil, it is filled to the brim. Second tank, what has happened is, they have built up a small tiny wall attaching to one wall of the tank, and without filling oil into the tank, they have filled it into this tiny tunnel. And the guy who climbed up to the tank has put the stick into this and say, even the second tank is filled to the brim of oil, and they have taken the measurement or the volume 100,000 liters. In the third tank, what has happened is, they have filled seawater in the tank. On top of that, they have put oil. You know, oil will come up and the seawater will go down, and it even was measured to be filled to the brim of 100,000 liters. Actually, only the first tank is filled with oil, the second tank is completely empty, and the third tank is filled with sea water. Now, the inventories were inflated. I mean, that was not an accidental inflation, that was inflated deliberately, and inventories are inflated by say 200 times. And this has been occurring over the period, and nobody could ever detect it. Now, this time only, auditors were so competent to detect it, and this time the audit supervisor himself climbed up to the tank and watched it and investigated, and he himself closely monitored the verifications without just waiting on the ground. Now, this man says this has been happening over 5 years time. Inventories were inflated by 200% over 5 years time. So, that discovery of the fraud makes all the financial statements for the 5 years back inaccurate. Now, you need to get back to the reporting date and make sure, if the inventories were 300 million rupees, inventories cannot be 300 million rupees, should be 100 million rupees, and you need to get back to the reporting date and bring down the inventory level from 300 million to 100 million rupees, and also you need to adjust your profit figures accordingly. And this mistake can be sometimes pervasive, this error can be sometimes pervasive. We will forget about your audit opinion, and this discovery of error and the fraud in their financial statements make all the financial statements for the last 5 years inaccurate, and you need to get back to the reporting date, bring down inventories from whatever the value to whatever the value, and also you need to correct your profit figures for all the 5 years retrospectively, and that event is also considered to be what event? Adjusting event. I hope it was clear. The settlement after the reporting period of a court case, this confirms the existence and value of the entity's obligations at the reporting date. Even that was explained in my previous examples. The determination of the cost of the assets purchased after the reporting date. Financial year ends on 30th 31st December 2020. And the financial statements were authorized for issue on 30th April 2020. Just few months ahead of the reporting date, we had purchased some property, plant and equipment. Property, plant and equipment. It says the determination of the cost of the assets purchased after the reporting date. Now, we had imported them from an African country, say Angola, and we paid 1 million in the currency of the supplier's country, Angola, Angolian currency, I do not know what it is. And now, we paid, forget about the rupee value, and or else the value of this property has to be 1 million in the supplier's currency, and we haven't still settled. LKAS 16 requires you to recognize property, plant and equipment when two requirements are fulfilled. What is it? Make sure the assets will contribute a cash flow to the business in the future, and make sure the cost of the asset can be measured reliably. So, we have adopted Sri Lankan rupees as our presentation currency, but we are not in a position to measure the cost of this property, plant and equipment item in terms of Sri Lankan rupees, because the exchange rate has to be there. Now, the central bank does not give us the exchange rate for all the currencies in the world. It is available only for few popular currencies. Now, since the exchange currency is not available, to translate that into the entity's reporting currency, right exactly, I mean even on the reporting date, we have not been able to bring and recognize property, plant and equipment into the balance sheet. We have not been able to. And with lot of efforts, we have been able to determine the exchange currency or exchange rate of the two currencies after the reporting date and during the subsequent period, and then only we can recognize the asset into the books. Being able to translate the value of property, plant and equipment from the supplier's currency into the currency of the reporting entity satisfies the recognition criteria of property, plant and equipment. What are those two criteria? Making sure that the assets will contribute a cash flow to the business in the future, and making sure that the cost of the asset can be measured reliably. Now, those two were completed during the subsequent period. So, are we going to recognize property, plant and equipment during the subsequent period or on the reporting date? You need to bring it to the books on the reporting date. You need to bring the assets to the reporting date. I mean, you need to bring and recognize them on the reporting date without recognizing them onto the to the books on the date on which the cost was measured, and the assets were existing on the reporting date. It is only just that the value or the cost could not be measured. And now, what was the condition existing on the reporting date? The condition is that the assets are existing on the reporting date whose values cannot be determined, and the exchange rate being made available during the subsequent period is the event that provides evidences and information in a way that the values or the cost of the assets can be measured reliably as of the reporting. So, this event of the exchange rate being made available is also an adjusting event, and you need to recognize it on the reporting date. The determination of the proceeds of the sale of an asset sold before the reporting date. Same story, but the other way around. And just few months ahead of the reporting date, we sold some of the assets of the business. Carried value was 5 million rupees and it was sold to an African country, say Angola. And the selling price, we haven't still fixed, it was 50,000 in an Angolian currency. But to calculate the profit or loss on disposal, you need to have the selling price in terms of the currency of the reporting entity, not in the currency of the buyer's country. Now, until right up to the reporting date, we never got the exchange rate. So, we got the exchange rate somewhere here during the subsequent period. You cannot derecognize the asset from the books and to recognize the profit or loss on disposal on the date on which you got the exchange rate. No. There was a condition existing on the reporting date. What is the condition which is existing on the reporting date? Asset being derecognized, the profit or loss being recognized are the existing conditions on the reporting date. Here, those conditions can be measured reliably, or we are receiving conditions, we are receiving evidences to the conditions existing on the reporting date from this event of the exchange rate being made available during the subsequent period. So, then the asset should be derecognized. Which asset? The asset sold need to be derecognized and the profit and losses need to be recognized not to the period on during which we got the exchange rate, but to the date, the reporting date. By why? Because that is an event which is providing us evidences and information. So, the conditions that exist on the reporting date. So, this event of the exchange rate being made available should also be an adjusting event, and that is similar to the previous example we discussed. The determination of the profit sharing or bonus payments after the reporting period, even that was explained. So, we can move on to the next category of events, non-adjusting events, and let me explain it first and then we will explain the examples. How does LKAS 10 define non-adjusting events? Those are the events that are indicative of conditions that arose after the reporting date. After the reporting date. See how nicely those two events are contrasted from each other. Adjusting events are the events that are providing evidences to the conditions that are already existing on the reporting date. There are conditions that are existing on the reporting date for which you start receiving more information, you are starting to receive more evidences to those conditions existing on the reporting date, and that is what is happening under adjusting events. Non-adjusting events are the events that show, that are indicative of conditions that are arising completely extensively after the reporting period. Now, reporting date, as I said before, 31st December 2020, and we had 5 million worth of debtors. And if a particular debtor who owes us money on the reporting date became bankrupt during the subsequent period, that becomes an adjusting event. Because the debtor was existing on the reporting date and that was not the conditions. What is the conditions? Impairment provision should be created for the receivable balances existing on the reporting date, and that is the conditions existing. So, the event of the customer being bankrupt gives us evidences enough in a way that the provision for the receivable balances can be created. Now, let us see how this is contrasted from the previous one. Now, what I am going to say is this: a particular customer who arose completely after the reporting period. Now, we sold goods to the customer on 10th of February 2021 with a value of 1 million rupees with a credit term of just 1 month's period, became bankrupt somewhere here before the financial statements were authorized, and that particular event of the customer being bankrupt has got nothing to do with the debtors on the reporting date. Why? This particular customer never existed on the reporting date, and this customer arose completely after the reporting period. And this event of the customer being bankrupt is an event which is completely indicative of a condition that arose after the reporting period, and that was not a condition existed on the reporting period. So, then if you decide to recognize impairment loss, or if you decide to write it off as bad debts, you need not to get back to the reporting date and to do it, and you should recognize that impairment loss to the period during which the bad debts arose. I hope it was clear. Then, let me explain each and every single event in this list given in our slide. A major business combinations after the reporting date or the disposal of a major subsidiary company. December 2020, financial statements were authorized for issue on 30th April 2021, and somewhere here, say 1st March, this entity has decided, or the entity acquired another subsidiary company on 1st March 2021, and that particular event of the entity being concerned acquiring another subsidiary company has got nothing to do with the balance sheet date conditions. Why? Maybe the parent company, which is the reporting entity, decided to acquire the subsidiary company after the reporting period. They discussed the values, they did the due diligence exercises after the reporting period. So, nothing was existing on the reporting date. And this business merge or the combination is a condition that completely arose after the reporting period, and there was no condition. So, that nothing was existing on the reporting date. So, you need not to do any consolidations on the reporting date. You need not to do any calculations on the reporting date. Why? This business combinations has absolutely got nothing to do with the reporting date. I hope it was clear. The entity acquiring another subsidiary company is an event which is indicative of conditions completely arising after the reporting period. It has got nothing to do with the reporting date. Major purchases and disposals of assets after the reporting date. Now, we had some similar examples before. In my previous examples, I said assets were either purchased or sold, of which the cost of the assets or the selling prices were determined after the reporting period. Then the sale transaction truly occurred during the reporting period, but it is only just that in the absence of the selling prices, the cost of the assets acquired, you can't determine the selling prices or the disposal profit or losses. Here what has happened is, you never sold the assets before the reporting date. You never sold the assets, you never purchased the assets before the reporting date, and you sold the assets after the reporting date. You purchased the assets after the reporting date. Everything took place after the reporting period. Nothing of them has got nothing to do with the reporting date, assets and liabilities. So, then these are events that are completely arising after the reporting date and the period. So, you need not to adjust them on the reporting date, you need to do the accounting for all those transactions during the subsequent period. I hope it was clear. Destructions of assets by fire after the reporting date. I took this example before, say property, plant and equipment, and during the New Year season, most of the people were on leave and nobody knew about what is going on in the factory, and there was a small spark of fire somewhere in the factory, and that has developed into a flaring fire just in few hours time. Almost all the machines in the factory were badly damaged, they were destroyed and devastated during this period, and you should recognize your impairment if needed, you should recognize your losses if needed, not on the reporting date due to, it has to be during the subsequent period. Why? The destruction of the assets by fire has got nothing to do with the reporting date. It has to be completely on the report, it has to be completely during the subsequent period. So, that destruction of assets by fire after the reporting date should be adjusted to the subsequent period, not on the reporting date. Announcing or commencing a major restructuring after the reporting date, and that is an example that requires some detailed explanations, and let me do it. Now, restructuring program is a discussion arising out of LKAS 37, not from LKAS 10. What a restructuring program should be learned not from LKAS 10, it has to be learned from LKAS 37. Now, I can't explain the absolute definitions of restructuring now, because it is part of LKAS 37 and you will be able to watch the videos of LKAS 37 later. Now, to get an example, to give you an example for restructuring, let us say we have 10 factories and we are in the garment industry, and we have 10 factories located island wide, and out of the 10 factories, 3 factories are located in Biagama trade zone. So, the management has decided to close down the 3 factories in Biagama trade zone and to terminate the services of everyone who worked in the factory so far. There are 15,000 people working all together, so the decisions were taken to terminate the services of everyone, even including the management and the managing director of the 3 factories, or the production manager, whoever who tops the hierarchy. Now, couple of meetings were held with regards to the decisions to close down the 3 factories, and various decisions were taken at different meetings conducted throughout the year, and finally, right before the reporting date, the management decided to terminate everyone and to pay compensations just within 1 year's time, or just within the immediate next year, to finish it off paying all the compensations to all the people who lost their jobs. The total compensations will be 50 billion rupees, a massive amount of money, a hefty amount. And nobody knows, and just a rumor is spreading all over the factories saying that the factories are going to be closed, but nobody knows officially when and how and whose jobs will be lost, and so on and so forth. Now, the entity decided not to let anyone to know that the factories will be closed before it is implemented. So, the entity decided to communicate it personally to each and every single one who is going to lose their jobs, the fact that we are going to close down the factories and we are going to pay compensations, and we are going to communicate to each and every one the amount of compensations to be paid. That will happen not during the current year, that will happen in the next year. So, then 15th March 2021, the entity started sending letters to each and every single employee who is going to lose their jobs, stating that the factories for which you worked will be closed, and indicating the amount of compensations to be paid within the specified time frame, and the letters were sent only on 15th March 2021. Now, LKAS 37 together with LKAS 10 say that this event of the affected parties being communicated during the subsequent period is not an adjusting event, it is an adjusting event. Why? Because an obligation does not exist on the reporting date. For an obligation to exist, what is the obligation for? To pay. The obligation to pay compensation exists on the reporting date only if you communicated it to the affected parties. Now, say for an example, you sit for CL2 exam and your parents had fixed in their minds to buy you a valuable gift if you pass the exam, but it was never shared with you right before the exam. Since your parents did not communicate it to you or shared it with you before the exam, they do not have the obligation, because you do not know. But if before the exam your parents communicated it with you and shared it with you that they are going to buy you a valuable gift after getting through the exam CL2 paper, then only the obligation start existing. Until such time that is shared and communicated with the parties concerned, the obligations do not exist. And now this entity never let anyone to know that the factories will be closed and the compensations will be paid. Since it was not communicated to the parties concerned, the obligation to pay compensations does not exist on the reporting date. The obligation started existing only after it been communicated to the parties concerned. So then, since the obligations or the liabilities were not existing on the reporting date, it is not an adjusting event and it becomes a non-adjusting event, and you need to just do the required disclosures. Let us see what the required disclosures are as we proceed. So now the restructuring program was done. They formulated the restructuring program. It was not implemented before the reporting date. It was not communicated to the parties concerned either before the reporting date, and it started being implemented, it started being communicated to the parties concerned after the reporting date, and then only the obligations started existing. Since the obligations were not existing on the reporting date, that event of the restructuring program being communicated has to become a non-adjusting event and not an adjusting event, and just a disclosure will be required and no accounting need to be done. Next one, large changes after the reporting date in foreign exchange rates. Right. Now, this entity has adopted Sri Lankan rupees as their functional currency. That is part of LKAS 21. And also they have some items of revenues that are denominated in foreign currencies, US dollars. Reporting date is on 31st December 2020. Just 2 months ahead of the reporting date, a revenue transaction occurred and is denominated in foreign currencies, US dollars. Then the exchange rate was 190. So, the entity recognized their receivable and the revenue at the spot exchange rate of 190, credited sales by 1.9 million rupees and debited receivable by 1.9 million rupees. And this is due in 3 months' time, that is on 31st January 2021. And towards the end of the year, on the reporting date, the exchange rate has moved from 190 to 200 rupees. In case the customer remits us money on the reporting date, the amount to be credited to our rupee account will not be just 1.9, it will be 2 million rupees. So, you letting this amount to be at 1.9 million rupees is like you understating your assets. So, you will restate your receivable from 1.9 million rupees to 2 million rupees. And after the reporting date, unexpectedly, there was a significant depreciation of rupee, and that has moved from 200 to 250. And your receivable balance in terms of Sri Lankan rupees will not be 2 million rupees, it has to be 2.5. And this appreciation, this depreciation of rupee value during the subsequent period does not necessitate you to restate your debtors from 2 million rupees to 2.5 million rupees on the reporting date. You can continue your debtors to be at 2 million rupees continuously. Additional amount of 500,000 arising as a result of depreciating rupee value against US dollars can be recognized to subsequent period. 500,000 will be recognized to subsequent period, not to the reporting date. So, this abnormal or large changes in foreign exchange rates after the reporting date does not become an adjusting event on the reporting date and should be a non-adjusting event. Equity dividends declared or proposed after the reporting date, and let me explain that in detail. Here it talks about equity dividends, so let me take preferential dividends at the same time. Dividends are profit distributions, and if the profits will be retained in the company, we call it retained profit. If you decide to distribute the profits among the shareholders, never do we call it the profit, now we call it dividend. So, different terms are given for the same figures at different junctures. Now, let me first take preferential dividends, not equity dividends. Let me first take preferential dividends. Reporting date 31st December 2020. And we had issued 500,000 preference shares. And we had promised to pay 4 rupee dividend a share. Preference shares are different from the equity shares. One prominent distinct feature is that the preference shares do have a fixed dividend, whereas equity shares do not have fixed dividends, and the dividends for equity shares will vary from time to time, year on year, depending on the profitabilities and the volumes of the profits at the discretion of the management and the directors. Now, the dividend payment to preference shareholders should be 2 million. At the time of issuing preference shares, right in the prospectus, we have prominently shown for everyone to see that the entity undertakes to pay 4 rupee dividend per share and total dividend payment should be 2 million. What are dividends? Distribution of profits. For you to distribute, there should be a profit, and without you having profits, what the hell can you distribute? Now, if the profits are exactly 2 million rupees, so the entity cannot retain anything, they need to pay off everything as dividends. This is the profit that appears not in the audited accounts, but in the management accounts. The profit that appears in the management account should not be the final conclusive profit figures. You need to wait until the audit is over. Now, in the audited accounts, the profit figures were confirmed to be 2 million rupees. and this was done not right during the current year, in the next, in the following year. What I am saying is, the profit to be distributed, the amount of profit to be distributed should be decided not by looking at the draft accounts, by looking at the audited accounts. So, the audit of the financial statement is complete not during the current year, in the following year. In other words, the amount of profits to be distributed by way of dividend should be decided not during the current year, but in the following year. Now, what I am saying is this: since you promised to pay dividends, fixed dividends of 4 rupee for a share in the prospectus, a constructive obligation is existing, constructive obligation, because you included that clause in the prospectus. So, a constructive obligation is existing on the reporting date to pay dividends. Just imagine that clause was not existing, was not included in the prospectus, but we had issued preference shares about 15 years back, and every year we had the practice of paying 4 rupee dividend for a share every year. So, we have created a valid expectations in the minds of all the shareholders that every year the entity undertakes to pay 4 rupee dividends for all the shareholders. Now, that again creates a constructive obligations on the reporting date. Why the past practice? What I am saying is, as far as dividends for preference shares are concerned, a constructive obligation is existing on the reporting date, either because we have included a clause of fixed dividend to be paid in the prospectus, or we would have developed a practice of paying a fixed dividend to shareholders. A constructive obligation is existing on the reporting date to pay dividends to preference shareholders. Why? Either because of a published policy of dividend payments or past practice of paying dividends. But to decide the amount of dividends to be paid, you need to wait for audited accounts, and the audited accounts will be received not during the current year being concerned. You will get the audited accounts in the next year, in the following year. So, the amount or the volume of profits to be used for the dividends cannot be decided right now, you need to decide in the next year. And if the audited account says that the profit figure for the year is 2 million, that particular event gives us the evidence that the amount of dividend to be paid to preference shareholders should be 2 million, and that is like you receiving evidences with regards to the amount of dividends to be paid, and the obligation was existing on the reporting date. You are under the obligation to pay dividends also on the reporting date, which it's only just that you do not know what the amount is. You get to know about the amount only when you are receiving audited accounts. So, this is an adjusting event, and these dividends need to be adjusted on the reporting date. So, if you declare dividends and if the shareholders confirm it by looking at the audited financial statements, that becomes an adjusting event. But remember, please, for the God's sake, it's only the dividend being confirmed by the shareholders for preference shares, not for equity shareholders. And if at the exam, the examiner says that the dividends for the preference shareholders were confirmed by the shareholders during the subsequent period, it does become an adjusting event. So, the dividends need to be recognized to the financial statements on the reporting date. Also, your obligations and the liabilities to pay dividends to preference shareholders should be recognized on the reporting date. But if you receive that evidence or information for equity shareholders, it does not become an adjusting event, that is a non-adjusting event, and I must explain the reasons for that too. Reporting date. December 31, 2020. Financial statements were authorized for issue on 30th April 2021. Now, we had ordinary shares that were in issue of 500,000. And you know it better than I do. Never does a company promise to pay a fixed dividend to ordinary shareholders. And if you happen to see a prospectus for the issue of ordinary shares, you can start going through it from the beginning to the end, to the beginning, from the middle to both ends, to see whether there are provisions to fix dividends to ordinary shareholders. It never can you find it, it is not included. Why? An entity that issues ordinary shares never promises a fixed dividend to ordinary shareholders. Now, a company can wait without paying dividends to ordinary shareholders for years and years, for centuries and centuries and millenniums, but they will decide to pay dividends for various other reasons. And even if the company decides not to pay dividends for another 10 years ahead, the shareholders can't help and they have to shut their mouth and wait. It is completely at the discretion of the management and the directors, and the shareholders can't open up their mouth to ask for dividends. So, as a result, since the company never promised to pay a fixed dividend regularly every year, on the reporting date, never does an entity have an obligation to pay dividends, fixed dividends to ordinary shareholders, no obligations. And it is very unlikely of a company of having a policy of paying a fixed dividend continuously. Why? It is completely at the discretion of the management. It is the director board who decides whether to pay dividends or not to pay, and how much of dividends to be paid. And this year they will decide to pay, next year not, and next year again they will decide, and they will decide not to pay for another 5 years. And even if they pay dividends every year, the amount of dividend payments will go on varying from year to year, year on year. This year 1 rupee, next year 2 rupee, then again 3 rupee, then again 10 rupee, then again 20. It depends completely on the profitabilities and the decisions of the directors. So, company cannot have a past practice of paying a fixed dividends to ordinary shareholders. Neither can a company have a published policy of paying a fixed dividend to ordinary shareholders. As a result, it is contrasted from preferential dividends. An obligation, constructive or legal obligation, does not exist on the reporting date to pay dividends to ordinary shareholders, does not exist. Then, for the year 2020, the entity decided to pay dividends of 2 million rupees, and the directors proposed and the shareholders confirmed, and this event of the dividend being approved by the shareholders does not provide evidences to a condition existed on the reporting date. Why? since obligations did not exist to pay dividends on the reporting date, this event of the dividends being declared and approved by the shareholders is an event which is indicative of conditions arose completely after the reporting date. So, this dividend need not to be adjusted on the reporting date, you need to adjust it to the period during which the dividends were declared and approved by the shareholders. I wanted you to understand that in nitty-gritty, so that's why I just thought of explaining that in detail. Then major ordinary share transactions after the reporting period. Now, it is very simple. The reporting date can be like 31st December 2020 and this is 30th April 2021 and this is where we are. For some reason or other, the shareholders of the company would have thought of infusing more capital to the business, and for that purpose they just thought of going for a new share issue, and that share issue has got nothing to do with the reporting date items, reporting date balance sheet, reporting date conditions. So, this share issue subsequent to the reporting date is completely an event that is indicative of conditions that arose after the reporting date. It has got nothing to do with the reporting date. So, this is not an adjusting event, it is non-adjusting. You need not to do any adjustments on the reporting date figures. Changes in tax rates or tax laws enacted or announced after the reporting period. Say during the reporting period, the existing tax rate was 20%, and accordingly we have recognized our current taxes and deferred taxes based on the existing enacted tax rates. And subsequently the tax rates were revised from 20% to 28%, so that is applicable for that period. It will not be retrospectively applicable for the previous years. So, for the next year you can recognize your current taxes and deferred taxes based on the new rates enacted. So, that has got nothing to do with the taxes already recognized on the reporting date. So, that is completely a non-adjusting event. Entering into significant major litigations arising solely out of events that occurred after the reporting period. Now, in my previous examples, I took an example where a customer who purchased goods from us filed papers against us claiming 100 million compensations, because he claims that the goods we sold to our customers were defective goods, not quality goods. And then later during the subsequent period the judgment was delivered, and even before that we were well aware of the fact that we would be losing the case and we would become liable to pay compensation. So, that was confirmed from the verdict, from the judgment. Now, here what it says is the litigations were entered into not before the reporting date, and that was completely after the reporting date. Entering into significant litigations after the reporting date, and this is where it occurred, and the customers would have taken legal actions here, and we became liable to pay compensations, and this is an event which has got nothing to do with the reporting date, and this is an event that is indicative of conditions that completely arose after the reporting date. So, it is not an adjusting event, it is non-adjusting event. So, those are the examples, and there can be some more. This is not the exhaustive list of examples for non-adjusting, there can be some more. And if it is a non-adjusting event, you need not to do anything on the reporting date, but on the reporting day you need to do some disclosures. So, let us see what disclosures are required. If it is a non-adjusting event, the disclosures to be made are basically you need to do two disclosures. What are these two? A description of the event has to be disclosed. You need to explain the nature of the event, whether it was a destruction of assets as a result of a fire, or whether it was major share issues after the reporting period, or whether it was a restructuring program that was communicated to the parties concerned after the reporting period, or whether it was a business combinations after the reporting period, or whether it was a customer being bankrupt after the reporting period. I mean, the customer who was not existing on the reporting date would have become bankrupt after the reporting period, and that has to be disclosed. So, the nature of the event has to be disclosed. Its estimated financial effect. If it is a non-adjusting event, you not only disclose the nature of the event, also you have to explain the financial impact. Say, if it was a destruction of assets as a result of a fire, you need to explain the nature of the event, and also you need to explain the financial impact on that, financial impact of it, what the loss has been without adjusting the loss to the financial statements on the reporting date. On the reporting date, you need to explain the nature of the event plus its financial effect. Then there is another important area to be discussed in LKAS 10, that is going concern issues arising after the reporting date. There is an exception to the rule that the financial statements reflect conditions at the reporting date if after the reporting date management decides to liquidate the entity or cease trading, or decides that it has no realistic alternative to these actions, the financial statements cannot be prepared on a going concern basis. In accordance with LKAS 1, management must disclose any material uncertainties relating to events or conditions that cast significant doubt upon an entity's ability to continue trading. This applies if the events have arisen since the reporting period. If the going concern assumption is no longer appropriate, then LKAS 10 states that a fundamental change in the basis of accounting is required. In this case, entities will prepare the financial statements used in the breakup basis. If the financial statements are not prepared on a going concern basis, that fact must be disclosed. Now, let me take one of the examples I took before. The reporting date is 31st December 2020. And most of the machineries in the factory were destroyed following to a massive fire. Now, the machines in the factory were like the bread and butter. It was these assets that kept this company moving forward. And some of these machines are very rare in the world, and hardly do we get a supplier whom those machines can be purchased from. Now, even to find a supplier of the machines, it will take many years. And then resuming our operations and bringing it back to the normal conditions will be so tiring and will be so hard. And we know this particular destruction of assets will impede our business from progressing, will impede and will resist our business from proceeding, and will resist our business from progressing ahead. And also there is no resilient activities to these destructions. You cannot find supplies of the machines, it is very rare, and even though the suppliers are there, they do not have stocks with them. Sometimes you need to wait years and years to get the machines manufactured. So, as a result, this particular event will cast a significant doubt on the ability to continue as a going concern, and we know without the machines we cannot do the productions, and our customers will be desperate, and our customers will not wait for years and years till we get back to our normal operational levels, and our customers will go to the other suppliers, and we need to recanvas our business, we need to find our customers, and that's going to be like you starting a fresh business from a scratch, and this is so hard. So, the management decides we have no option but to close down the business. That particular event, which is not an adjusting event, will result in impeding the business from progressing, and if that casts a significant doubt on the ability to continue as a going concern, you need to do some disclosures as required by LKAS 1. In accordance with LKAS 1, the management must disclose any material uncertainties relating to events or conditions that cause significant doubt upon an entity's ability to continue trading if that particular subsequent event is casting a significant doubt on the ability to continue as a going concern. You must make the required disclosures as required by LKAS 1. So, we have discussed the going concern matters in LKAS 1. You need to rewatch those videos if you have forgotten them. And if for some reason the going concern assumption no longer applies, if that going concern assumption is no longer appropriate and applicable to the entity, LKAS 10 says that a fundamental change in the basis of accounting is required, and there will be significant changes in the way in which the financial statements are presented. You know, we either use historical cost or fair values to show assets and liabilities. Hereafter, if the going concern assumption is no longer applicable and appropriate for that entity as a result of this event, you will not show the assets no longer at historical cost or at revalue, it may be at forced sales value. Assets and liabilities are shown, and we make a distinction of assets between current and non-current if the entity is a going concern, but if the going concern principle is no longer applicable, the distinction of assets into current and non-current will no longer be appropriate. You need to put everything under current. All the assets need to be realized as fast as you can, all the liabilities need to be settled as fast as you can to finish off everything and to close down the business. So, everything has to be categorized under current liabilities, and you need not to show research and development under intangibles, and you need not to show deferred revenue, you need not to recognize deferred taxes, all those need to be recategorized. So, there can be drastic changes in the way in which the financial statements are presented if the going concern assumption is made no longer appropriate as a result of the subsequent event. And then if the subsequent event impairs the ability to continue as a going concern, then that automatically becomes an adjusting event, and you need to prepare the financial statements in a different way. So, that is our discussion of LKAS 10, and hopefully we have covered very important areas in this series of webinars. Hopefully, these series of videos will be of a massive and immense use for you to succeed at the exam. All the very best for the exam. We will meet up again in the future.